Welcome to our 3-part series on investment basics. Two, diversify or spread your bets. So we've determined that taking stock market risk has some potential rewards in the form of higher returns. But not everyone is, nor should they be, willing to put up with the full effects of those corrections or bear markets we discussed. The trick is to diversify your investments or spread your bets. This is called asset allocation. Through asset allocation, you invest a portion of your money in different kinds of investments: stock, bonds, and cash. By doing so, we try to lessen the severity of those inevitable market corrections. The goal of asset allocation is to manage the amount of risk you take while still achieving a desired rate of return. This strategy has worked over the years for a couple of reasons. First, each of these asset classes, stocks, bonds, and cash, carry a different level of risk and a different potential return. Generally speaking, stocks have achieved a greater historical average rate of return than bonds, and bonds a greater rate of return than cash. On the other hand, cash and bonds have not suffered the kinds of corrections that stocks have. Finally, in some years, stocks may perform very well, while in other years, bonds have performed better than stocks. By having some money in each of these, you've reduced, not eliminated, the severity of a stock market correction, while striving to achieve an acceptable rate of return. The ratio of stocks to bonds to cash is the art and science of asset allocation. How much of each asset class to have in your portfolio should be based on a couple of key things. The closer you are to the time when you'll need the money, the less aggressive you should be. This means if you're 60 years and nearing retirement, your allocation should be heavier on bonds and cash than, say, a 30-year-old just starting their career. That 30-year-old has more time to recover from a market correction than a person getting ready to retire, so having more stock may make more sense for them. Next is your tolerance for risk. How able are you to ignore market corrections when they happen? We'll talk more about this in Principle 3. This is a gross oversimplification of the asset allocation process. There is strong theory and research as to how to mix the various asset classes to optimize returns and manage risk. In addition, there are a lot more asset classes that should be considered. For example, in this session, we looked at stocks as a single asset class. In the real world, there are lots of kinds of stocks: foreign, small cap, emerging markets. You get the idea. If you need help with this, contact your advisor. He or she has tools and experience to help you create a good allocation model.